Hello, welcome to my retirement roadmap. This is the next video in a series of videos on investment portfolios. And this video, we're going to talk a lot about investing. So, kind of an interesting story. When someone learns that I am an investment advisor, like a friend or a friend of a friend, maybe a family member, they'll be like, "Hey Ty, what's the best? What's a really good investment that I should look at?" And they're kind of looking for the next Nvidia, something that's really going to make some fast money type of thing. And the thing I want to say, I don't do this, but the thing I want to say is, hey, listen, the best investment that you can make is in yourself. And in particular, I'm talking about in your own fitness. Talked about that in other videos, but take care of your health, your fitness, eat right. That is the absolute best investment you can make. So all that being said, the rest of it is, if we're talking about the stock market, particularly, that's what people are really asking, or other forms of investments. Okay, what should they really do? I proudly say that I'm pretty boring when it comes to investments. I've heard others say that, so I didn't coin that term. But I'd like to, kind of have that as a badge of honor. When it comes to investments and investing, I'm pretty boring overall. And I also believe that I'm just not as smart as some of these really, really sharp people who are out there and they do it for a living. I just say, hey, listen, the best I can do is invest in the total market, okay, and into an index fund. That's the way I look at it when it comes to investing. And we're going to walk through a lot of things as we do this. And just a warning, some of this can get a tiny bit tedious, but I just want to talk more about why I feel that way. So I've mentioned this in earlier videos about how I retired earlier than I expected. So basically, I was in the saving for retirement phase. And then all of a sudden, I decided to retire probably 10 years before I would have. And just an opportunity came up. So I retired. I had to pivot quite quickly to learning how to go into what we call decumulation mode. So now we're spending what we've saved. Very different. So, and I didn't want to pay someone else to tell me how to do that. Through my own pride and arrogance or whatever you want to call it, I had to learn it myself. Okay. And it's kind of interesting because the investment part, it's the fun part. It's the sexy part. People are like, and people like to talk about it. They say, hey, look how much money I made on this stock, or I hear this one is really the next one to have. You hear a lot about the success that people have, and sometimes the bad stocks that they pick, you don't hear a whole lot about it. But anyway, I just wanted to say that's what it comes to as far as investing. I tend to be pretty boring. And as I was transitioning from the saving for investment into retire, spending from these savings, I was doing a lot of research, spent a lot of time. And it was kind of funny because one day I was listening to a podcast, I think, this is the way I remember it. And I was like, oh, here's this Bogleheads type investment. And that kind of sounds like the way I am. I really, that's how I've kind of sort of figured out how I like to do investing. So I think that's important. I have a huge nod to the Bogleheads. I've been to 2 conferences so far, 2024, 2025. I've learned a lot. Great resource. If you happen to be on my website, you'll see a link to the Bogleheads University. Phenomenal information. It's all free. It's very professionally done. Much better than what you're getting from me. But anyway, just a nod out there to the Bogleheads. All right, so let's talk more about how I like to keep things simple when it comes to investing. And we'll first start off with crypto. So in my portfolio, I have no crypto. I'm not saying that's good or bad, that crypto is good or bad. I'm just saying I don't use it. Again, I'm in retirement, so there's not a lot of runway. If something goes off the rails, there's not a lot of runway because we are in retirement. So we have to be careful in that scenario. So crypto is very interesting to me. I've been trying to understand it for a few years. I have yet to find somebody who can explain it to me well enough that I could say I'm okay with investing in it or avoiding it. I like the blockchain technology. I think that's quite fascinating. But as far as making money making money on crypto, I just don't quite understand it enough. It is not part of my portfolio. Moving along, I don't include any individual stocks in my portfolio, none at all. A good story here is before I retired, when I was saving for retirement, Jeff and I would we'd pick some stocks here and there and say, hey, listen, we kind of believe in this, and this is great, so let's go ahead and invest some money in there. We had mixed results. Okay, some took off, some didn't. But the interesting part of this is when I became a licensed investment advisor or registered investment advisor, I decided that I shouldn't never say never, right? But I wasn't planning on advising people to own individual stocks. Like this is a good company, you could invest in this for whatever reason. Wasn't planning on ever doing that. So then I thought, well, I still have like 5 or 6 stocks that I have in my portfolio, and I just need to let them go. Go ahead and sell them. And when I look back on that, it was really tough. I did not want to do that. I kept delaying it. But finally, one day, I did it. I pulled the trigger, sold all the stocks. For the next 24 hours, I was like, oh man, I feel bad. It was kind of like, you'd had so much emotions invested in these stocks, and you wanted them to do well, and you thought, you'd listen for things that were good or bad about these companies. Sold them. Felt bad for about 24 hours, and then it was like this huge burden just lifted off my shoulders. Didn't have to worry about them anymore. It was a done deal. It is, they were gone. Didn't have to worry anymore. Now, truth be told, because we own the total U.S. stock market, we do, still have positions in those companies, but it's in an index fund. So it's kind of an interesting thing there. And the other thing that we'll see as people go into retirement is they may have worked for a company and have a lot of employer company stock in their portfolio. So those are concentrated positions. Those can be a little tricky. So those need some special handling. So if you have that situation, definitely talk to a financial advisor, investment advisor to work on that. There's a thing called NUA. Okay, I won't go into that now, but that's something to be aware of. Make sure that if you're in a position where you have concentrated employer stock, make sure to ask about NUA. Moving along, no bond funds. I don't use any bond funds in my portfolio, just tips. And I've talked a lot about tips in different videos, probably more than I should, but I really do like tips as far as bonds. And that's all I have in my portfolio, are tips when it comes to bonds. Those are the only bonds I have. I say here, no target date funds in my portfolio. And I want to talk just a little bit about target date funds because they can be very helpful to people when they're going through investments. And I used target date funds for quite a while as I was saving for retirement. They are effectively actively managed funds to a certain extent. It just depends on which target date fund you're using, but they really are meant to balance the portfolio and keep that portfolio so that it matches the year of retirement that people are planning for. They can, and I think these are really helpful for people who are, maybe they're just starting out saving for retirement. They say, hey, I'm just going to put it here. This is going to work. That is a great option. As I transitioned into retirement, it became very clear to me that the target date funds are not really the best option for people in retirement. That's the way I look at it. And I've talked about the envelopes and how those things are set up. And that's something that the target date funds aren't going to really handle very well. Okay, so again, I don't use any target date funds in retirement, but I do think they are very valuable depending on a person's investment, where they are in their the saving for retirement. Moving along, no annuities. The A word. Sometimes you hear about the A word. So annuities. I'm not saying that annuities are good or bad. I think there are annuities that can be very valuable in people's portfolio, but I don't use them at this point. That may change for me personally and maybe recommendations to some clients, but right now, don't use any. The the single premium immediate annuity, that's the one that is to me the most likely to happen in the future if needed, because that can provide that consistent payment for the rest of a person's life. For example, because you make one investment and hand out. So it's similar to like Social Security if you do a SPIA, single premium immediate annuity, and as long as it's done with a reputable company, because these are life insurance. Excuse me, they're insurance policies. They are insurance policies in the investments. They're handled by them. So you got to make sure that it's a reputable company, highly rated. Going on, I guess I'm spending too much time on this. Sorry. And then the deferred income annuity, that's a cousin of the SPIA. And that's just saying, hey, listen, I'm going to go ahead and make a payment now, and in 5 years from now, then we can turn on the annuity, that sort of thing. So these two, I think, can be very powerful. They are simple when it comes as far as annuities are concerned. They can be considered simple. Those are the two there. The MIGAs, or multi-year guaranteed annuities, those are also they're very similar to CDs, bank CDs, or CDs you buy in a brokerage. They're similar. They tend to have a higher return, but again, they are annuities. They're insurance products, so they can be useful, but you got to make sure you understand how they work. The fixed index annuity is also a popular annuity. In my experience so far doing investment advice, I've actually helped people get out of these fixed indexed annuities, typically because they were bought when interest rates were very low and things aren't. It made sense to get out of them. So they can be useful in a portfolio, but I don't use them. And make sure you have done your homework as far as making sure that they are the right thing for you. Variable annuities are extremely interesting. They can be pretty complex. I don't use them. Again, and I think I mentioned somewhere along the road about there can be complex products that can simplify retirement. And this is an example of that. Variable annuities can make retirement itself simpler, but they're very complex. There's just so much going on with them, and that you definitely have to work with a person who understands those really well. And the RILAs, those are kind of, I guess they're kind of a hybrid between the fixed index annuity and the variable annuity is the way I look at it. But again, these are products. Annuities tend to be complex. They can definitely be valuable, but it's something that in my portfolio of trying to keep things simple, I don't use those. Now, I mentioned life insurance when I was talking about annuities, but I meant to save that here. So in my portfolio, I don't use life insurance, but that can definitely be part of a much more sophisticated portfolio. And I don't want to spend a lot of time on this, but life insurance is really meant for people who have really large estates, and they gotta manage those things, and they're trying to set things up so that, especially so that the taxes will be more efficient. So we're talking about people with very large estates, something that is way beyond the scope of what I do as far as investment advice. If you fall into that situation, you definitely want to talk to an estate planning attorney and probably a financial advisor, investment advisor who has a lot of experience with handling large estates. So life insurance can be a very powerful part of a portfolio, but that's not something that I do. Buffered ETFs, I don't use buffered ETFs, but they're gaining popularity. they're coming down in cost, and definitely something to keep watch on are these buffered ETF products. So I won't go into anything on those now, but I did want to say that they are definitely catching my interest, and may be looking at those in the future. I've also said, I guess it's kind of apparent, I don't care for active management. I think that's important, and we'll talk more about that in just a second. No master limited partnerships; those are complex investment products. Not saying that they can be good or bad, but they're definitely more complex than I like in portfolios. No private equity. Private equity is kind of getting a lot of attention lately. That seems to be one of the latest buzzwords as far as investing goes. I personally think private equity belongs with the really sophisticated investors, thinking of college endowments, university endowments, big hedge funds probably, or pensions, like state pension funds, that sort of thing. So the private equity, that's the way I look at it. That's really where private equity belongs, not for the retail, investor like ourselves, just a regular person. Okay. That's the way I feel about it. And keeping it simple. And I don't put that in the portfolio. And then real estate. I don't use real estate in portfolios. So, but it is interesting that in the total U.S. stock market, there are some real estate investment trusts sitting in there. So I guess in a way they are. And most people get real estate with their residences. Maybe they have their primary residence and maybe another second residence, like a vacation home or something like that. That's probably enough real estate for most of us. So that's the way I look at it. I don't do anything special there. And then there's another one that I would mention too is precious metals like gold, silver, platinum, whatever. I don't use any of that in my portfolios, but I do know some people like to have some of that. They, consider that that's a safe reserve against inflation and whatnot. But I don't. In mine, I think we're covered using the three envelopes, and we've got protection against inflation, et cetera, built in. Okay, so I did want to say a little bit about active management, and this is kind of it's hard for me to explain. I would do my very best. If you go out there and you do an AI, say, hey AI, tell me a little bit about active investing, and really what's going on here is if you take the active investors, they're buying the U.S. stock market, for example. That's really what it is. The active investors, people go out and buy stocks, trade stocks, etc. That's active investing, and that before costs, these average active investors will get the market return. So you take the total market return divided by these investors, and then they've got the average active investor. However, when you subtract the costs of active investing, okay, because you got to pay your hired an active investor, you're in an active investment fund, then the average active investor must underperform the market because of those costs. So that's why I like using an index fund, the total U.S. stock market index fund, that very low cost. We'll talk about it in the next video. But then you're doing better than the average active investor. So I like that. And I don't try to be sophisticated in this. We just use the total U.S. stock market, because the total U.S. stock market has small cap, micro cap, large cap, mega cap. It's got all the sectors. They're all covered in there. And then there's other research that says, hey, listen, it's basically the net worth in the stock market is basically attributable to roughly four companies. And the tricky part is determining what four companies those are. So that's why if you own the entire U.S. stock market, you've got the companies that are creating the most value in that. So just wanted to point that out. I hope that helps a little bit. Finally, I wanted to share the metrics on our portfolio, okay, as far as where it is. I think this this kind of holds me accountable to what I'm talking about. So I wanted to share this. Of our, I'm not giving numbers, I'm going to give percentages, but of our investable assets in so that we can go out and invest them in the stock market or however we wanted to, okay, we have 14% of that is in cash. So that's sitting in basically money market funds. Okay. And those money market funds are currently right around 3.3%. So if you sort of say, well, inflation is running somewhere around 2.3%. Okay. I mean, Social Security went up 2.8% last for this year. Okay. So let's just lower it a little bit, say inflation's going down type of thing. And I know there are different inflation metrics, but let's just say it's 2.3%. Right now, money market's paying 3.3%, and that is after fees. So we're basically getting a 1% real rate of return on the money market. So our portfolio has 14%. That's way higher than I want it to be. We've got a lot of money sitting in cash. And I keep saying I'm waiting for the stock market to drop, so prices go down. That's when stocks are on sale, that's when you want to buy. But the stock market's been, hanging in there. So just wanted to say that. The tips, which are bonds, that right now is 24% of our total portfolio. So when you add the cash and the tips together, we're talking about 38%. So that leaves 62% is in the stock market. So you might have heard of the 60-40 portfolio. So this is really a 38, 62%. Personally, I'd like to be closer to 70% equities, but we do have a lot of that money sitting in cash, waiting for the stock market to drop so we can go purchase some stocks when they go down. That's what you want to do, right? You want to buy when the prices are low. Buy low, sell high type of thing. Okay, and then as far as the total as far as the stock market is concerned, I wanted to say that 79, or let's round up to 80% is in the total U.S. stock market, 20% is in international. Personally, I like just owning the U.S. stock market, and I say that the big companies like Apple and Microsoft, Nvidia, they're all selling their products around the world. Okay, so don't we also have exposure to the global economy through that? But I was at the Bogleheads conference in 2024, and there's some really smart people, and they're like, well, yes, you're probably okay with just the U.S. stock market, but you might want to think about having some international. Okay, so that means publicly traded stocks that are not on the United States Stock Exchange, on a U.S. stock exchange. So that's like, you might want to own some. So, and also want an index fund, right? So I did move some money into international. I'd had it before years ago, and I sold it because it was doing so terribly. But I went ahead and did it, and that was good advice. Because in 2025 the international did really well. So that gives you an idea of where our portfolio is. I just wanted to share that as far as investing. Again, I'm just trying to keep it as simple as possible. Don't need to be fancy. I don't pretend to be smarter than the total U.S. stock market. I just don't see any way that I can be. So that's why I keep it simple and put money there. Thanks, and we'll see you on the next video.